I'm just curious, Tony, thank you so much for being here.
Thanks for having me.
Thanks for not being on vacation, although maybe this
Somebody's
is vacation.
gotta work.
Yeah, exactly. I am curious about whether you have seen any kind of drop-off in any material way, or whether that resilience that we see in the hard data really has been a theme for you as well.
So we just did Q1 earnings. January and February were gangbusters. And then you saw the consumer pause a bit in March, and we saw some softness in March. But April and even the early days of May, we started to see a little more stabilization. So the days of post-pandemic double-digit rate growth is behind us, and we're seeing more stability. But we saw globally a little over 4% RevPAR growth in the quarter. Softer in the US, about 3%, closer to 6% internationally. And I think that's a theme that will continue. We'll see we'll see growth, but a little more modest growth in the US. Every international market except Greater China with really strong both RevPAR and unit growth.
Can you build on that in terms of what's behind it? Is it this idea that the rest of the world doesn't want to come to the U.S. because Canadians are mad? Or is it that right now it seems like the U.S. is the place where people are showing the greatest amount of discretion with respect to spending?
Yeah, there's a few things in there. Maybe I'll attack the narrative a little bit about inbound. To be sure, we're spending a lot of time with Secretary Lutnick's team, with Secretary of Transportation's team, because there is some concern from international travelers about, are they welcome in the U.S.? What's their experience going to be coming through customs and immigration? With that said, in Q1, we saw inbound from Canada down about 5%, but total international inbound for our business was up. And so the drop in inbound Canadian was offset by inbound from other parts of the world.
Tony, is this the year where ADR growth for limited service hotels actually outperforms that for luxury hotels? I mean, talk to us about consumers' relentless search for that White Lotus experience.
I think it's going to be the inverse. In Q1, the strongest occupancy growth we saw globally was in the luxury tier.
Yep.
The Select brand, slow and steady on the occupancy side, but not nearly the pricing power we saw coming out of the pandemic.
Well, I want to shift gears with you, just if I may. I know we want to talk about tourism as we head into the summer. At least that's what Lisa wants to talk to you about. But I want to talk to you about hotel investment. I mean, the U.S. saw hotel investment down 11.5% in last year. It's down 40% since 2019. Are international opportunities crowding out the U.S. market? Or are you seeing something similar abroad?
Yeah, so when I think about our growth, our investors, our owners, and our franchisees, they have all gladly and willingly decided to invest in an industry that is cyclical by its nature. The good news is most of them are very long-term asset holders, so they're not necessarily timing their investments for a quarter or two. These are assets with 20, 30, 40-year useful life. It's not lost on me that against the backdrop of a lot of economic headwinds, a lot of uncertainty, we signed more deals and more rooms in 2024 than in any year in our 98-year history. In Q1 of 25, with more and more headwinds and uncertainty, most productive growth Q1 we've had in 98 years. And so what that would suggest is both here in the U.S. and internationally, the investors believe long-term in this fundamental shift from the consumer to prioritizing travel and experiences in their spending.
Tony, a quick question. So what's the difference between what you see on the business side and the consumer side? Is there a big difference?
Business side meaning business travel?
Business travel, excuse me.
So we think about our business in terms of three segments. The group segment, which has been the strongest segment for the last number of quarters. In Q1, global group RevPAR was up 8%. The other thing that's nice about group is we've got more visibility over the medium term because those customers tend to book out a few years. The two transient segments we have, leisure transient and business transient, which is your question, the booking window is sub 21 days today. So I can tell you what I know today, but with the caveat that trends could shift relatively quickly because we have such a short booking window. Within business transient, we look at small and medium-sized businesses and then the big multinationals. Small and medium-sized demand recovered several years ago. It was one of the first segments to recover. Big multinationals are still down double digits from where we were pre-pandemic. The good news growing sequentially quarter over quarter, but modestly. In the quarter, business transient was up 2%.
And just to follow up to that, on the consumer side, are you seeing people book later and later?
We are.
You are. Okay.
We are. And you know, I'm here for the NYU investment conference, so I did the CEO panel yesterday, and we all had a similar perspective that while we're pleased with the level of growth that we're seeing, you sort of go to sleep at night and wonder, I wonder what's coming tomorrow, because that consumer, because of all this uncertainty, is sort of standing on the edge of the pool saying, should I book, should I wait? And thankfully, so far, they've been booking.
Well, this is a reason why I think a lot of people have been wondering what the read-through is for the consumer. And you've been talking about how it is down in the U.S., or it isn't necessarily growing as quickly as in the rest of the world. How do you see that manifest? Is it with respect to an inability to absorb higher pricing? Is it for people who are looking for value in the very many ways that you can put that out there?
Yeah, I think if you look at our brand strategy, it is reflective of exactly what you described. So we have brands from mid-scale all the way to ultra-luxury. But we're seeing a bifurcation of the consumer in the U.S. and in many markets where we operate. That's why you're seeing us double down on the luxury end of our portfolio, because that consumer has almost an insatiable appetite for travel. It's also the reason that 2 years ago we made a big push into the mid-scale segment, which was a segment we didn't operate in just 2 years ago. And what we hear from that lower income consumer, they absolutely, just like the higher income consumer, are prioritizing travel and experience, but they need to do it through a value lens. And our entry into mid-scale is allowing us to open the aperture a little bit and bring them in.
Before we let you go, I want to talk about the other side of the equation, which is the hiring side.
Yeah.
And I remember during the pandemic when it was really hard to get everybody back. And I wonder from your perspective, especially with some of the questions around immigration and the changes that have happened there, whether you've noticed anything with how hard it is to hire people, whether that's shifted either salaries or just some of your recruitment plans.
Yeah, thankfully, some of that confidence around the job prospects in the travel and tourism sector that was shaken in the early days of the pandemic seems to have faded in folks' memory. We've got lots of candidates. Our number of open positions here in the U.S. is lower than it was pre-pandemic. Wage rates are certainly rising, but every time the job report comes out, you see that travel and tourism sector leading in terms of job creation. And so we are having good luck filling open positions.